what are bonds? So bonds are basically, by this definition, a fixed income instrument that represents a loan made by an investor to a borrower. So in simple terms, it's basically a loan that investors give. It's a loan that investors give to the government, corporations, or institutions. So basically, when you purchase a bond, you are loaning your money to these people. And so, how do bonds work? So basically, for bonds, there's the face value, which is basically the amount that you're going to be repaid when the bond matures. So maturity for a bond is basically when the term of the bond, look, in this definition it says 5 years. That means after 5 years you will receive your principal back. So maturity basically means the time, like the amount of, like, when this bond expires and you get your principal back. Your principal is basically the amount you invest at the start. So face value is basically the amount that is paid back. So let's say you spend $1,000 on a bond. That means that the face value is 1,000. Yeah, $1,000 is basically the amount that is repaid at maturity. This is not price, by the way. It's not price. I almost got myself confused. It's not price, because price is determined by the bond market. And you might think, but like, if they're so I should explain what bonds are basically. So bonds are different to stocks. So stocks is basically like a percentage share in a company, right? And in a stock, you take on all the risks of the company, and you also take the earnings, or you can get dividends as well. While a bond is more of a, you can think of it as an IOU to someone else. And for bonds, it's not, you can basically like think of it as like two types. You have the government bonds, which are usually not risky unless you're looking at risky markets that are in war crisis. Let's say Ukraine. Since their economy is not so strong, they offer a high bond yield because they want you to give them money, and then for your risk of them not defaulting, they're going to give you a high interest rate. So default is basically if the institution or company or country can't pay back their debt to you, and this is really risky. So they have a high interest rate. They have a high interest rate to compensate for this. There's also, but like for government bonds, you have the U.S. bonds, which are like, I think they're the least risky bond available. Treasury bills. Treasury bills. Basically, the U.S. government asks you to lend them money. So U.S. asks you to lend them money. And let's say you wanna lend them $1,000. Let's say you have $1,000 lying around and you want to make some passive income. You can lend this to the U.S. government. Let's say you buy a 5-year bond with the U.S. government. Let's say the interest rate is 5% on this bond. It could be 4%. We'll just use 5% for simplicity. So bonds are calculated through simple interest, or slash fixed, simple slash fixed. So basically, you can calculate your return by 5 times the 5-year bond. So when this matures, you will earn $1,000 times by the return of 5% times by 5 years. So this would equal 25%. So you would earn $1,000 times by 1.25, which is equal to, you'd earn 1,250. You'd get $1,250 and you'd gain a $250 profit over 5 years. You need to hold this bond for 5 years to get $1,250 guaranteed as long as they don't default. Okay, and this is a not risky bond. There's also corporate bonds, which is where like businesses like ask you to give them money for them to invest or do whatever with it in return for a usually higher interest rate. So if the government is 5%, it could be like 10%. So if you have a 5-year corporate bond, it's probably lower, but we'll just use 5-year. So you'd earn like 5 times 10, so you'd earn a 1.5. You'd earn 50% on this bond, so you'd earn $1,500. But there's also a risk of bankruptcy. Bankruptcy for this company, because it's a company. Well, and it is more risky for a company to go bankrupt rather than the government. And you might think like stocks, let's say for the past 5 years, let's say the SPY or slash S&P have basically returned an 85% return for 5 years. And so if you compare this with the US bond, we have 25% here and we have 85% here. Well, that's the difference. Stocks are risky because stocks are basically a collection, like an ETF like SPY or S&P. It's basically the top 500 companies. And these companies, if there's a recession, they will earn less money because consumers are less willing and able to spend money to fuel these businesses' profits, and that means your stock will go down because your stock is a percentage of these earnings or dividends from a company. And during times of crisis, you don't get the same sort of return. And so the advantages, so it is good for stocks that the last 5 years their return has been good, but sometimes, let's say during the dot-com bubble crash, so if you invested at the really peak, I think it'd take around 15 years for you to break even. 15 years without inflation. And that's another thing I'll cover later on, how bonds like will adjust for the inflation and interest rate. And so bonds are basically consistent. You can think of it like this. Stocks are more like volatile. They can go up, they can go down. You don't really know. But usually they go up. Like for the past few years, few decades they've been going up. Like you don't know when you will invest in, you don't know. You could get a loss if you invest there and you sell there. But usually over time it's usually a straight line going up. Not so straight line, but it's usually go up. What bonds are more like a staircase because you will if you invest in less risky bonds, your returns will be pretty consistent. But if we put this on the same chart as stocks, it's gonna look like this because your returns will be probably less than stocks because it's less risky. So basically, the more risk you take on, the higher your sort of returns are in the eyes of the market. So there are risks with bonds. You might think, oh yeah, stable 5%, but you forgot to take into account there's inflation. And so inflation, let's say if inflation's at 3%, inflation, let's say 10 years. So you have a 10-year of 5% bond. Let's say you have $1,000. This would turn into $1,500 in these 10 years. But you forgot to take into account this inflation. Let's say the inflation is 3% for 10 years. 3% times 10 equals 30%. So inflation's at 30%. So your 1,500 is now worth 30% less. This would actually only be worth $1,050. And now I'm going to talk about the interest rates and how interest rates affect bonds. So interest rates are set by the federal government. They basically choose the rates that interest rates and conversely the bonds will give. So when interest rates go down, the the price of bonds, go up. Let's say you purchase bond A. Bond A is, let's say it costs you $1,000 right now, and the face value is also $1,000. This is a par slash face value, and this is the price. And let's say 5% yield for 5 years. 5 years. While you, so this is the first bond, right? So in 5 years, this bond would return, would give you $1,250, so plus $250. While, and let's say during this 5 years, let's say on year three. So currently you are given back $50 for the first year, $50 for the second year, and let's say you just got your third payment for the interest. And remember, you get your principal at the very end. So you get your principal here at year 5, you get your principal. So this is where you get like the last interest rate, the coupon payment plus the principal, I'm pretty sure. So plus the $1,000. So bonds are not fixed. Like this $1,000 is not fixed. It fluctuates. It's in a free market. So basically, during this time, if the federal government reduces the interest rate from 5%, let's keep it simple, to 7%, your bond is worth less. Now, it's because, let's say bond B just got released on the third year 3 inception, okay? And it gives you 7% returns. The price of bond A will go down because there is a better return on investment bond available, and they are taking on the same risk of being a US Treasury bill. So this price will probably correct. They use a complicated formula, but we can say, let's just say maybe like $950. It will correct somewhere like that. It will correct in such a way that these returns are equal. If you buy bond A, you miss out, and you immediately sell it, you incur a loss without the coupon payment. Let's say you bought bond A for $1,000 3 years ago, then you sell it currently at $950. You lose the $50, but you might earn $100 from the coupon payment. So from year 1, year 2, or if you include year 3, it's $150. Now, if you reinvest this money back into here, the market is efficient, so it kind of makes sure that bond A and bond B give the same return on investment regardless if you swap or. And when I say swap, I mean like when you switch from the 5% bond yield to the 7% bond yield, if you were using the entire 5 years. So the price of bond A goes down. So instead of $1,000, it's now $950, but the par value is still $1,000, and it will give you the same interest rate. So the only way you lose out is if you don't invest the full amount back into the bond. So in summary, so you can invest in bonds through the U.S. You can invest through the U.S. slash the government's websites, right? Or you can, if you have a stock brokerage, you can also ask the brokerage, or you can go through ETFs for bonds that track the returns of bonds. They track these returns through holding the bonds. And since this is their income and you're entitled to a part of it, it is tracking this, minus the maintenance fee. So yeah, that's it. Hopefully you learned something today about bonds. Bonds, in summary, are basically like a less risky, and it's a solid return on investment from your original capital, and it's a loan to another person, entity, government, corporation, institution. And hopefully you learned something today. Peace out.